Let's talk now about thinking of the value that an individual stock has. Now, obviously, it's very difficult to think about what the stock price should be. Stock prices can change greatly over time, but we need a starting point. We need some sort of general technical analysis to think about how stocks arrive at a certain price. There are two ways stocks provide value. So when we think about the profits that are generated, people normally focus on this first one probably more than they should, which is from price increases. So if you're thinking about buying stock, the main reason you're probably buying stock is because you expect the price to go up, right? You would never buy stock expecting it to go down. So price increases is one of the two ways that stocks gain value. And this can happen from two ways. One reason stock prices can go up is because of demand going up. So if people think Tesla is going to become really profitable in the future, people will want to buy Tesla stock today, right? Because they're hoping they can have it when prices go up. And when they buy Tesla stock, that itself drives the price of stock up. It's just simple supply and demand. When demand goes up from D to D2, that will drive the price with it. But that's not the only reason prices go up. The second is from supply going down. When a corporation buys back shares. So thinking about Tesla is probably not a good example, but let's think about a really well-established company. Let's think about a company like Apple. Apple actually does this quite a bit. If Apple is being profitable, then that means they will have profits, right? When Apple receives a very good month of revenues and its revenues cover its costs, well, then it's got profits. One thing it can do with that profits is actually buy back some of its pre-existing shares. So if there are currently 1 billion shares issued of Apple, they might go in and buy 50,000 of those shares back. And what that does is it reduces the supply and increases the value of all outstanding shares. So what this does is, on a graph, is when Apple buys back shares, it takes some of the supply out of the market, and that also increases the price, okay? So we can see prices going up because of demand rising, because people expect a company to become profitable. We can also think about it in terms of a company buying back some of its pre-existing shares. Either way, the price goes up. That's not the only way, the only value that comes from stocks. The other is from dividends. And a dividend is just profits that are paid to the shareholders. So when a company like Apple has a profit, it actually has a few different options, all right? If Apple has a profit, one thing it could do is reinvest that profit back into the company. So we could take $10 million and use it to develop some sort of new computing software. If it does that, it's hoping it will drive up demand, so shareholders are cool with that, right? If they take the $10 million and use it to develop something really good, then the demand for Apple stock will go up, which increases the price. Second thing they can do is buy back shares. So if they've got $10 million, they can then buy back some of those shares. That raises the price of Apple stock. Investors are cool with that. And then the third possibility is they could pay out dividends. This is the most straightforward method. A dividend is literally just profits paid to the shareholder. Remember that shareholders are residual claimants, which means if there's any profit left over after all of the costs, that can go to the shareholders, all right? So a dividend is just a chunk paid out to the investors. And so what you might see is a company like Apple might have a 2% dividend strategy, which basically just means that they're going to pay out 2% of the stock's price in dividends every year, right? And this can change dramatically over time. If the share price goes up, well, that kind of changes their situation. So it's not set in stone. But when you see these really well-established companies like Apple, they will almost always pay out dividends, which basically just means they're giving profits to their shareholders, all right? By the way, this second one right here has become a lot more popular over time. There's a couple of reasons for that. One, it appears that investors pay too much attention to this. So when they see prices going up for Apple, they get really excited and maybe buy some more shares. And the second thing is this is actually taxed more favorably. When you own shares of stock, you don't pay taxes on those shares until you sell them. So if the price goes up, that's not a taxable event. That doesn't change your taxes. But on the other hand, if dividends are paid out, you are immediately taxed on that. So a lot of investors actually prefer this method now, and this is becoming much more common over time. So what that means is, from a demand standpoint, from an investor standpoint, we have to think about stock prices and dividends. So if we're trying to estimate what a stock is worth, we might just take a simple strategy like this. The price today, right? When you see that little zero next to these symbols that I'm going to be using, that is like right now. So zero means no years into the future, right now. So if we're trying to figure out the price of a stock today, you might just think about it in regards to the payments you're going to get. So imagine you're going to buy Apple stock and you're going to hold it just for 1 year. The price of that stock, from your perspective, if we're thinking about it like a present value calculation, we can just think about all the payments that might show up. So one of those payments is a dividend. And maybe the dividend is not until next year. Maybe Apple's already paid out their current year dividends, okay? So their next dividend they're going to pay out is exactly 1 year from now. Then the dividend value divided by 1 plus I would simply show you how much you value the future dividend you're going to receive today, all right? So if the dividend is $2 a year from now, we can think about what that $2 is worth to you today. And then the other thing you care about is the price 1 year from now. So you're going to receive a dividend perhaps, also the price hopefully will go up, and likewise, that is just a future payment, okay? So when we think about stocks, we can just think that the price of a stock should be based on all future payments, just like it is with bonds, right? The future payments for bonds determine its current value. The same thing for stocks. The big difference being that these are much more unknown when it comes to stocks. So you might expect to have higher interest rates for stocks. Indeed, that's the case. To extrapolate from this a little bit, okay, we notice that we've got a couple of unknowns here. Dividends, we might actually have a pretty good feel for what a dividend might be next year. But this one right here, the price next year, that is certainly very much unknown. So we might wonder what determines the price next year. Well, the price next year can be based on the dividends and the price in the upcoming years. So if we're thinking about 1 year from now, imagine you just jump 1 year into the future. Well, 1 year into the future, the value of that stock is based on the dividend 2 years from now and the price 2 years from now. So what this allows us to do is we can then just take these values and replace it into that equation there. And what happens is you should recognize that if you take this far enough into the future, you can just keep making these same calculations, all right? So just to finish this off here, we can rewrite this now to look like this. Okay. So just taking the value and recognizing that the price next year is also based on future dividends and future prices, we could rewrite this first equation to the second one here. But there's no reason to stop at 2 years. The price in 2 years will be based on future payments. The price in 3 years will continue to be based on future payments. So we can extrapolate this out and say that a general formula for the price of stocks just looks like this. We'll call this the model with a future sale, just to give it a name in case we need to refer to this in the future. This is like a beginning point to thinking about the value of stocks. So that is the stock price today if we think about it relative to all future payments. So if I'm going to hold stock, let's say I'm going to buy stock today and hold it for some number of years in. All future dividends are relevant to me, and the price that I sell it for is relevant to me. It's also possible that I get a dividend in the first year, right? I could put that in the first year here. It's also possible these dividends could come out not in these even increments. Maybe it's 10 months from now. Well, I could change this to 10 over 12. But this is a nice simple place for thinking about how stocks get their value. The value today is based on all future prices and all future dividends. So what this tells us is that stock prices are forward-looking. This is really important to recognize, and I'm amazed by how few people understand this in the general media and among just normal members of the public. So if you think about a company like Tesla, who's had a rapid increase in their stock price, Tesla's not profitable, right? Companies like Uber is not profitable. But the reason their stock is valued at a high price is because people are expecting that some of these future payments will be high. People anticipate that they eventually will become profitable. And when they are eventually profitable, that means the dividend payouts will get bigger over time. And it means the price that you eventually sell that share for will be higher over time. Likewise, this also indicates that the stock market is not a good indication of the current economy. So during 2020, we saw this big increase in stock prices. And I saw so many people saying things like the stock market is out of touch because we had COVID and at the same time the market was gaining every day. That doesn't mean the stock market is out of touch. It just means people were really optimistic about the future. When stock prices go up today, that doesn't mean the economy is good today. It means that people are expecting these payments to be higher in the future. So when the stock market goes up, that's indicative of people expecting higher profits in the future. It's very much forward looking. It looks into the future. So there are companies like, GM. GM pays out really big dividends, but their price is kind of low. That's because people don't think GM is going to be very profitable in the future. They're going to struggle against competition from companies like Tesla. And then there's companies like Uber, which are losing companies right now. But people figure that eventually Uber is going to become profitable because they're going to develop self-driving cars. They might eventually have drones to carry things around. There's a lot of potential there, all right? So it's the potential, it's the promise or the potential of future profits that people really care about. So to build upon this model, there's a bit of a realization we can make here. When we set up that formula like we just did, the last payment, what's at the very end, is the price. So when we have that little PN at the end, right? This little figure right here. To think about it, right? What determines P? Even price, even the P in year end is based on future dividends, right? And if you take this really far into the future, imagine you're thinking about 1,000 years into the future, where this is PN 1 plus I raised to the 1,000. That value right there is actually going to be really small because it is discounted so aggressively 1,000 years into the future. Choose some values and you can see what I mean. Imagine the interest rate here is the required interest rate is like 6% and the future payment's $1 million. That still comes out to a pretty small value, very close to zero. So the thing to recognize is since the price, we can continue to push it back, right? The price today is based on prices a year from now. The prices a year from now are based on prices 2 years from now. We can take that all the way to prices 1 million years into the future. Because of that, the price is actually kind of irrelevant, okay? Because prices are based on future dividends and future prices, we can push everything off into the future. But the dividends aren't. The dividends are right there in front of us. I'm going to get a dividend payment next year, and the year after, and the year after that. Those are realized in very short increments. So the dividends actually are the key in this model. And so dividends are going to be the focus. The realization here is that dividends are the true driver of stock valuations. Or we might say, perhaps, nowadays, that dividends plus stock buybacks are the driver of valuations. But the bottom line is that price isn't really the driver, okay? It's what companies do with the profits that they have in the near term. What they do 1,000 years from now doesn't really matter because that's so far into the future. What we care about is what's going to happen in the next several years. So we really should focus on dividends. And what we need to figure out is what determines dividend payouts. And that is incredibly complicated, right? Because that's based on future profits and everything else. But we're going to do just some very basic analysis and create something called the dividend discount model, okay? So think about it this way. Let's imagine that a company currently pays out a dividend. We'll call that D with a little zero next to it, right? That zero just means today. So let's imagine that a company pays out a dividend today, and they're also going to pay out a dividend in 1 year. And for our purposes, let's imagine that they just do these nice, simple increments, right? The dividends get paid out exactly in 1 year increments into the future. Well, then we could create just this really little simple calculation here, which just suggests that the dividend they pay out next year is the dividend this year times 1 plus some sort of growth rate. All right? So if the dividend today is $1 and the dividend they pay out next year is $1.02, well then the G there is the growth rate of the dividend. We get a 2% increase in the dividend growth. So G represents the growth rate of dividends. It's really impossible to determine what dividend growth will look like in the future, right? It's really impossible, right? We do not know what Tesla or Amazon or Apple are going to pay out in dividends 10 years from now. But we might think about using a growth rate. We might think about Apple and say that Apple's dividends have been increasing by about 3% per year. So we could use G to be 3% to help us in our calculations here. Okay? Building on that, let's go another year into the future. If G, which is the growth rate of dividends, if it is constant over time, which we will assume it is, because remember, this is something very complicated that we're trying to simplify. This is not meant to be reality. It's just meant to give us a starting point to think about how stocks gain their value. Okay? If we're going to take this 1 year into the future, D2 would be D1 times 1 plus G. Okay? So you always can just take the year before and multiply it times 1 plus G. So this might be 1.02, right? 1 plus the growth rate, 1 plus 2%. And it's still going to be 1 plus the growth rate here. So if we just replace what we solved for D1, if we replace that in the equation, then D2 could be written as D1 times 1 plus G times 1 plus G. All right? Right? This right here, that right there is how we solve for D1. Okay? I'm sorry. Made a mistake there. It should be D0. So this right here is how we solve for D1, right? That's just taking this formula right here and replacing D1. And then you just multiply that times 1 plus G, which is what we get there. If we take this and we move it to many years into the future, then we can just use a very simple formula here. That the dividend payout in any year far into the future would be the dividend payout today times 1 plus G raised to the number of years that we have. So if we're trying to figure out the dividend payment 10 years from now, we can figure that out by simply just taking the dividend payout today and multiplying it times 1 plus G raised to the n. It's really just a future value calculation, right? So the practicality of this and why we do it is we actually can know what D0 is. We actually know what the dividend amount is. And we might have some idea of what G is, the growth rate of dividends. And so this allows us to get some information about something that is inherently unknowable. We don't really know what the dividend payment will be 20 or 30 years from now, but this allows us to at least conceptualize what that payment might look like. And since investors are in an unknown situation, investors don't know what's going to really happen to dividends, We might think that they would use a similar process to determine what the price of a stock should be today. So although this is a little bit impractical, and although this isn't perfect, it might match what investors are really using today to decide what stock should be worth. So this might actually apply in terms of figuring out what stock prices should be today. All right, we're not done with this. This is just kind of a first step. Okay, so we got our basic little formula here, which allows us to solve for the theoretical payout of a dividend in years into the future. What we would like to do now is try to figure out what the payments are worth to us. Okay, so this just shows how much the payment would be. It doesn't consider taking the present value of that calculation. So let's think a little bit about dividends. All right, keep it in mind that dividends are really all that matters. If we believe that stocks are going to last for a really long period of time, then the price in the future is irrelevant. In other words, if I bought a stock today for $100 and I held it for 1,000,000 years, the price that I sell it for 1,000,000 years from now really doesn't matter, because it is so far into the future, it gets discounted to being worth close to $0 today. So instead, it's the string of dividend payments that really matter. So we can kind of think of it this way. Imagine if you had a stock that just had the following dividend payments. And this just lasted literally for infinity. What would be the present value of all of these payments into the future? Maybe you remember doing something kind of like this. All right, if you had dividends that were just constant all the way through time, then this would be the same thing as a console, right? The perpetuity, the console bonds that we talked about, where the price of a console is the payment divided by the required interest rate. Okay, so in regards to this set of dividends that's being paid out, if you're receiving $100 every year starting next year, and the required interest rate that you need to receive is 5%, then the price for this very strange stock would be $2,000. And that's how we did it for consoles, right? So the interpretation of this is, if you wanted to create a system where you receive $100 every year into the future, you would need to invest $2,000 today, okay? So $2,000 has roughly the same value as these payments in the future. The problem with dividends is they don't pay out a constant amount through time. So we're going to have to tweak this a little bit. Dividends tend to grow over time in terms of payments. So we can borrow from our ideas of the console and use G, which is the growth rate of bonds, growth rate of dividends, to create a new formula. Okay? Looks like this. The price today for a stock that we're not worried about the price, because the future price, we're going to sell it so far in the future. So we're trying to figure out how much we pay today based solely on dividends. Can be set up like this. And these are both the same formula here. And this latter one here, I'm showing you just because this is very similar to the console, okay? Console was the payment 1 year from now divided by the required interest rate. In this case now we're just including G in this. Mathematically it'll work out perfectly this way. The problem is dividend 1 year from now, we don't really know, and it's based on what we expect given current year dividends. And so as we've showed before, the dividend next year is the dividend this year times 1 plus G. So this first formula is the one we're going to be using, but I just wanted to show you how similar this is to consoles. Okay? Just to make sure we understand each of these variables here, D0 is the dividend payout today, all right? 1 plus G is 1 plus the growth rate of dividends. It's showing you how quickly the dividend is growing over time. So if that's 2%, that means every year the dividends get 2% bigger. I is the required interest rate that you need to receive. That's the risk-free rate of return in our economy. And G is that same G we just saw, okay? So what this would tell you is, if we wanted to put in some values, that if a dividend today pays out $100, okay, G is how quickly we expect the dividends to grow over time. Maybe that's 2%. And I is 6%. Well, then based on that information there, we could figure out what the stock should be worth. If this was literally true, we could anticipate the value of this stock. We could guess the price based on that information. So the price today would be 100 times 1.02 divided by 6% minus 2%. Okay? And whatever that comes out to would be the expected price for that stock today. One thing to notice is this formula only works if G is smaller than I, all right? And in fact, you'll get a really weird calculation. If G is greater than I, you would actually get a negative for this, which doesn't make any sense, right? Because if G is greater than I, that means dividends are growing really fast, so the value should be really high. Technically, if G is less than I, then everything is good. That works out perfectly, and that's what we're going to see almost always, okay? Should work out that way. If G is equal to I, then what you would get is infinity when you solve for this. So the value would come out to be worth infinity, right? I minus G is 0. 0 can go into this value an infinite amount of times. And if G is greater than I, then what you'll get here is a negative value, which makes no sense. This is total nonsensical. In reality, if G is greater than I, then the stock should basically have an infinite value, all right? So this only works really when we think about the scenario where the dividend is growing at a slower rate than the risk-free rate of return, which normally, but not always, would happen, okay? So that's an extension of the dividend growth model. And what we're going to do now as we build from this is we're going to start thinking about integrating risk into our calculations. Right now, we're just assuming these payments are guaranteed. We know for sure what those payments are going to look like. In reality, there's risk, okay? So if I solve for the value of a stock using this formula and the price comes out to like $250 a share, that's the price if there was no risk. Since people are risk averse, we know that they are going to be willing to pay less than that, and we need to include risk in our calculations. So now we can just add risk into the equation. It's not going to be a big leap. We just add just a little bit of extra material here, actually just one more variable, and we can incorporate risk into our calculation. So what we saw already is this formula here. It's called the dividend discount model. I've also heard people call it the dividend growth model. Looks like this. Okay. Where I star, to be clear, that's the risk-free rate of return. That's the I star that we saw in the bond market as well. However, what we know is stocks have risk, right? Stocks have risk for many different reasons. Stocks are risky in the sense that prices are very volatile. So if you want to think about volatility as being similar to risk, that volatility is something people don't like in general, right? Risk-averse people do not like volatility. Furthermore, stocks are risky because you are only a residual claimant if you are a stockholder, which means they have to pay all their other costs before that business pays out to the stockholders. And a lot of times companies issue bonds, which means companies have debt. So if a company has debt and they have a slightly bad quarter economically, they might not have any profits left over after they've paid off their debt, right? So the profits can be very small for stocks. So to increase our knowledge of stocks, to make it more feasible in terms of thinking about how this is in the real world, we need to add a risk premium. So we've got I star, which is the risk-free rate of return. We're now just going to add a risk premium. People will require extra compensation to invest in stocks, knowing that stocks are really quite risky, right? Individual stocks, individual companies are very risky, even the really well-established companies. And we can see that by looking back through time. As I mentioned before, the Dow Jones Industrial Average, the 30 largest companies in the United States, when that Dow Jones Industrial Average was first created, a lot of those companies, in fact, I believe all of them, are now out of the top 30. And some of them are gone altogether. Some of them are literally bankrupt, right? So companies can come and go very quickly, which means that there is a tremendous amount of risk when you're investing in an individual share of stock. So all we have to do to change our formula to incorporate risk is just add in the risk premium. Same formula, just adding in risk, all right? So you can think of it this way. If I'm willing to invest in something that has a 4% return, if 4% is my risk-free rate of return, the risk premium is the extra compensation I would need to receive, all right? So for example, just to give you a quick little calculation here, maybe for Coca-Cola, we might look at their financials, and what we would find is that they're paying out dividends. Established companies tend to pay out dividends now. Unestablished companies will eventually pay out dividends. That's the logic. You're thinking eventually they will. So Coca-Cola is a very well-established company. They do pay out dividends. It looks like they're going to pay out $1.64 a year. All right, that's based on their current expectations. And so that gives us D0. We know what they're paying out in 2021 at the time of this recording, okay? The risk-free rate of return. How could we figure out the risk-free rate of return? Well, there's no one answer, but we might look at treasury bonds, governmental bonds, right, which have basically no risk. The problem with looking at different bonds is they have different lengths to maturity, so they might have different rates, but we might just kind of get an overall average and say that the interest rate, the risk-free rate of return is 2% on bonds on average over the next 30 years, something like that, okay? The risk premium, we could solve for this. We could sort of think about this for individuals. So I might ask you, how much more a stock would need to pay out to make you choose it over a risk-free bond? So in other words, if I offered you a stock that I told you expects to return 7%, or a bond that has no risk that expects to return 4%, which of those would you prefer? And in kind of making those types of choices in our head, we can figure out what our risk premium is. So we might determine that the risk premium for society in general is 5%. And what that means is, for someone to have stocks, they need to expect to receive at least 5% more than they would on risk-free investments like treasury bonds. Okay? And then finally, we would need to know the growth rate, and we can estimate that based on what Coca-Cola has done in the past. And maybe what we find is that Coca-Cola, on average, increases their dividend 1% per year. All right, so you can think about this being practical or not. This is very practical. We know the dividend this year. The risk-free rate of return, we can kind of figure that out. Risk premium, we can estimate. And the growth rate, kind of have to guess there, but it's an estimation. So this is very imperfect, but again, keep in mind, all of this is very imperfect. No, there's no good way to figure out what stocks are going to do in the future. But we're just trying to give some analysis, some mathematical way of thinking about how prices are arranged in the stock market. So then we can just take those values and plug them into our formula, where the price today is the dividend this year multiplied times 1 plus G, the growth rate of dividends. Divide that by the risk-free rate of return plus the risk premium minus that growth rate for dividends. And what you would find here is that we would get a value of $27.61. Okay? Not perfect, but it is an interesting starting point. The logic here is dividends tell us a lot about a company's future profitability. And if we can estimate future dividends payments, and then we have some information about risk premiums and such, then we can arrive at some sort of mathematical calculation for stocks.